So, hey, everybody, this is my friend Penelope. She is working on her California real estate license right now, and she's been studying, helping me study today. We've been working on this together for a little while, and she is excited because she really enjoys real estate investing. She is looking forward to a career in real estate, sales, and investing. So I'm going to let her be the narrator today, and we're going to talk about financing, okay? So all right, Penelope, go ahead. Hit me with a question. What do you got?
Okay. An acceleration clause is inserted into a note that is otherwise negotiable. Adding this clause makes the note non-negotiable, is required for the note to be negotiable, has no effect on negotiability, but also is of no benefit to the holder of the note, does not limit the negotiability of the note.
Okay, so remember what negotiable means. That means that the loan, the promissory note can be sold or given to someone else, right? It can be transferred. It's something that's negotiable, is something that we can transfer. But this acceleration clause, though, would not limit the negotiability of the loan, of the note rather. What would the acceleration clause do? Remember when we talked about before accelerating the mortgage, we speed it up, right? So if there's an acceleration clause in the mortgage, it could be sped up. And the lender would say, hey, instead of the 20 years or so that you have left to pay on this loan, we want you to pay it right now. We're calling it all due right now. We're not playing around with you anymore, right? So that would not affect whether or not the loan could be sold. It just really affects the balance of the being called due early, okay? All right, so the next question.
When a lender loans a borrower 100% of the purchase price of a house and the loan is not government related, the lender would be best protected by low monthly payments, a low interest rate, appreciation, a downturn in the economy.
So think about this one. This lender has given them a 100% loan. They're not putting any of their own money down. That's pretty risky for the lender. So if the loan is good and everything goes well, and the borrower keeps paying, okay, cool. But if the borrower were to default on this loan and they had to sell this property at a foreclosure auction, what would happen? They would hope to get their money back. And the only way they could do that is if the property later became worth more, or at least stayed worth as much as when the person borrowed the money. If it went down in value, then they stand to really lose, because if they auction off and more is owed than what they get, they're in trouble. So we don't want to see the value go down. So the thing that they're banking on here and hoping for is appreciation, that the value will go up with time, right? And so that's the answer to that one. All right, cool. Let's see. Let's talk about this one next.
A release clause in a mortgage provides for an option to extend its due date, creates a lien second only to the lien of taxes and assessments, releases a guarantor from further liability under specified conditions, or allows portions of the property given as security to be released from the mortgage lien upon performance of a specified act.
So we've got the release clause. So what kind of a loan does that have to do with usually? Remember, that's the blanket loan where we've got usually the blanket loan, because we've got different properties being held as collateral under one big loan. Remember, we were talking about, if the investor has a bunch of apartment buildings and he puts them all up as collateral and he gets this one big loan, this blanket loan, then the release clause could allow part of that collateral to be let go as we go, right? So what does it do here? It would then allow portions of the property given as security to be released from the mortgage lien upon performance of a specified act. In other words, it allows the borrower to pay off a portion of the loan, and then it frees up part of the portion of the property or a portion of the collateral that's being used there, so they could go and sell it or do whatever they wanted to with it. Oh, this is a good one. Let you read that one. I gave you a long one.
Which of the following statements concerning typical land sale contracts is correct? The land sale contract is similar to a lease in that the buyer had a right of possession but no rights in the title. Land sale contracts are the least secure method of financing for the buyer because the seller retains the title and the buyer is merely the equitable owner. The buyer is usually not responsible to pay their property taxes until the seller has delivered a deed to the property. The buyer has absolute assurance of receiving title upon performance of the contract.
You're worn out from reading all that. So we're talking about a land sales contract, a land contract. Sometimes we call it a contract for deed. That's the owner financing, right? That's when the owner is financing the loan for the buyer of his property. So if I sold you my house and I let you make payments to me, I financed it for you. That would be a form of land contract or owner financing. So what do we need to know here? The buyer, what is he doing? He's trying to pay this contract off so that once at some point in the future, he gets the deed. So it's not similar to the lease, because in a lease, we would never own the property, right? The land sale contracts are the least secure method of financing for the buyer because the seller retains the title, and the buyer is merely the equitable owner. So yes, so let's talk about what does that mean? The seller retains the title. The seller is holding on to the deed to the property. He's holding on to the legal ownership until those contract terms are met. The buyer is the equitable owner, meaning he's working towards getting that property. He has a financial interest in that property, but he doesn't have the deed yet, right? That's why we sometimes call this a contract for deed. Until he gets that deed, he does not have the full legal title on this, okay? All right, let's do another one.
All of the following are true of conventional loans, except what? They are made to the buyer without governmental insurance or guarantee. They require a higher down payment than non-conventional loans. The policy requirements of the lenders are not uniform. The requirements to qualify are uniformly fixed by state law.
They're all true of conventional loans, except, so we're looking for the one that does not fit. So which does not fit? The requirements would not be set by state law, right? This is a private bank loaning money to their customer. So the state would have no say in those requirements, really. So they are made without governmental insurance or guarantee. This is true because remember, which loan is insured by the government? Remember that one? I put you on the spot. That's FHA, right? FHA is
oh my God.
Too much pressure. And the one that's guaranteed is VA, right? Because the VA has no money down. Perfect. So that's why conventional loans are not involving the government at all. So what about the higher down payment than non-conventional loans? There's a big difference between the down payment in conventional loans and the down payment in, like, say, FHA and VA. Because remember, on FHA loans, we only have to put 3.5% down as a minimum. On VA loans, we don't have to put any money down, right? No money down loans. And remember again that the conventional loans are the ones that we would need to put down 20% to avoid PMI usually. If we don't put down 20%, the bank's going to make us buy PMI. So let me ask you real quickly, Penelope, I'm going to put you on the spot again. When you're studying for your exam in between our meetings, what, as a student who's going through this right now, what advice do you have to the other students out there on how you're studying? Like, what's working for you? What do you think? What would you tell somebody?
The best thing for me has been taking notes and highlighting and using color. So like I'll be reading the textbook, and then if I see a definition I really don't understand or I can't grasp, I'll go into my notes and I'll highlight that definition, and then I'll write the definition. And then even after, I'll write an example of how I'd use it in the real world. And that's really been helping me.
The real life examples are perfect, right? That's what we're doing here. We're going through these questions and we're saying, okay, how would this apply to whatever we're working on or whatever we're doing? Like, you know, when we're talking about owner financing, the other day we were talking about hard money loans. We were talking about points that are getting paid on hard money loans, which ties back into the points that we've been learning about in finance, right? That when we pay points on a loan, we pay 1% of the loan amount per point, right? That's what the borrower pays. So in real life, when you're talking to somebody about like the hard money lending, and for those people listening who don't know what hard money lending is, that's when we're talking about taking out a short-term loan, usually at higher interest rates from a private lender, meant to like finance a quick flip on a return, you know, quick turnaround property, usually not something we would take out for 30 years, right? So that's a real life example. And there's so many things, like when I hear people say, well, nothing on my exam or nothing in my class is things that really apply to my real life work in real estate. I mean, there's a lot of things here that I need to know for my real life work in real estate. So I think that's a prime example. All right, let's do one more question.
Okay. A credit score scale used by many mortgage lenders that uses a risk-based system to determine the possibility that the borrower may default on financial obligations to the mortgage lender is known as a balance sheet, FICO score, preliminary report, or pre-approval?
What do you think?
I feel like it's pre-approval.
Well, but is that the credit score or is
FICO.
Yes.
Yeah.
Yes, perfect, perfect. The pre-approval is what we use the FICO for, right? What
I
we use
just
the FICO for.
had to do that like a month ago.
Right. And so we go through, we get our FICO score, we share that with the bank. The other things that we could share with the bank would be like our tax returns or our W-2s, 1099s, however we get paid. Our credit card statements would be scrutinized, you know, when sometimes when they want to make sure that we haven't, you know, borrowed money from different places that we're not supposed to. Like these sorts of things would come up. Another sort of thing that would come up is our assets. What do we own? What do we have to bring to the table? What have we acquired that could potentially be, you know, used as an asset? All these things are going to go into it and going to be part of the decision-making process for the bank. Now, when the bank gets all that paperwork together, pre-approves for the loan, we turn in our contract. We're like, hey, we're ready to go along with this loan approval. The person at the bank who's going to really scrutinize all of this information and make a lending decision on whether or not we're going to move forward, or he needs more information, or maybe this loan doesn't look right to him, is the underwriter, right? If we've heard the term underwriter, he's kind of the decision maker. He's the mover and shaker there. Okay.